Welcome back. Well, as we just discussed before the break, tech stocks certainly weighing on Wall Street overnight, with big names like Apple and Microsoft weighing as well in the S&P 500. So should investors be looking beyond the US when it comes to some of the tech names? Well, joining me now, Nathan Bell, Head of Research at Peters McGregor. Nathan, appreciate your time. I want to get to some of these Chinese tech stocks, because we've talked about them before. But firstly, what is happening on the Nasdaq? What is happening on with some of these, the FANG stocks, these big tech names?
Yeah, I think if you just take a bit of a broader look and just look back at even just 12 months ago where these shares traded, some of these companies are up 50%. Now, this isn't billion-dollar companies going to $1.5 billion companies. This is $350 billion companies going to $500 billion or $500 billion. So the question you've got to ask yourself, has there really been that much value created? Does the market really feel that much more informed 12 months on now and seeing all these great things happening? Or is this really just a sign that a lot of passive money that's not caring about value just going into the market? So
you suspect short-term sort of profit-taking, or just rotating into other areas, or maybe covering losses from other areas?
Look, I just think sometimes stocks have got to take a breather. Like, it's been straight up for so long. It's just the natural part of markets.
Can I ask a view on some of the valuations around them? Because certainly, I mean, you look at the individual stock price, and I know that's not the proper way to look at value, but it's hard for some people to get past, $1,000 a share and so forth. But if you look at it on other sort of metrics, they're not as expensive as some of the stocks that are trading on our market.
The way I would think about it, if we just take, say, Google or Alphabet and Amazon, the question you've got to ask yourself is, what are these businesses going to look like in 5 or 10 years? Because if they just stay the way they are today, they're not going to justify their valuations. Amazon needs to get their profit margins up to 3, 4, 5% in the retail business over time. Google can't just rely on its search business for 95% of its profits in 10 years' time like it is today, because everybody's working out how you can bypass Google search to get the same information. So the question you've got to ask yourself is, one, you've got valuation risk because the valuations are very high, but second, can you back these companies to adjust and morph their businesses over the next 10 years? And that's a very hard question to answer.
Is it almost having to take a leap of faith then, looking at what they've been able to do and have a belief in the management or in the key leader or founder to be able to continue to deliver that?
I think that's exactly the point. And with Google, they've got their moonshots, and you've got to back that they're actually going to make some money from them, because at the moment they make nothing from them. They're just a cost exercise. Amazon, again, you don't know what that business is going to look like in 10 years. But you wouldn't underestimate what they're going to do either. Bezos has done a couple of incredible things, and who knows whether he's got a third one up his sleeve.
So do the level of valuations for these stocks, do they worry you at the moment? Like, I know there have been comparisons, I would have thought unfounded, with the tech bubble that we saw. Is that too far away? Is that a concern?
Look, I think history tends to rhyme, but I think it's lazy analysis to say that just because there was a tech bubble 15, 17 years ago, we're exactly the same. But I think the companies today, they're much more dominant. Most of them are making real money. This isn't eyeball stuff. This is real cash coming out of these businesses. And the industries are so concentrated. The biggest fear about some of these companies now is they're going to get regulated, because Amazon, Google, Facebook, they're just so dominant, they've got no competitors.
Can we talk about another area with some... Well, they're not really emerging. I mean, these are dominant tech players in their own right, and that's out of China. Some of the big names there that you guys like.
So a quick one, JD.com, it's commonly called the Amazon of China. It does compete with Alibaba, and it doesn't have the big cloud services data storage business, so it's not exactly the same. But this company is growing 50%, its revenue is 50% a year. And the thing I like about it is it is a technology company, but it's more of a supply distribution type company. And in a real summary, Alibaba measures delivery times in days or weeks, and JD measures it in hours. And so if you can imagine to build a company with the culture of what you need to deliver boxes all around the world in a couple of hours in the right condition, all right, it's just incredible that it's happened so quickly. So it doesn't make a lot of money today, but it's much like Amazon 7 years ago. You're backing this company to make a lot more money in the future.
Why not an Alibaba? That would probably be the most commonly known name out of China. Why some of these other names as opposed to an Alibaba?
Yeah, the thing we like about JD more than Alibaba, and Alibaba might work out just as well. There's actually room for two of these guys. China's a big place.
It's big, isn't it? Yeah.
And there's a lot of customers, and they use online much different to we do in the West. They're using it for everyday goods. It's really their first port of call, because they don't have the shopping malls and all the retail infrastructure that they used to have. But the thing we like about JD is they're actually well known for having goods that are authentic. And on Alibaba, you get a lot of fakes. And if you're an Australian business, so you want to, you've got a cosmetics business or whatever it is, and you want to maintain the value of your brand, you want to partner with JD. You don't want to see your brand abused on Alibaba.
What are some of the risks associated with investing in China? I mean, there isn't the level I would have thought of, corporate governance, transparency. I mean, are those things that investors need to be wary of when going and investing?
Yeah, I think so. And I think you don't want to own these in the sort of, you don't want 10 or 20% of your portfolio invested in these sort of stocks, even though they might do very well. The thing is, there's so much growth in these businesses. If you just put even 2 or 3% in them, hopefully over the next 10 years they go up by 3 or 4 or 5-fold and they'll become good positions and you haven't had to put a lot of money at risk. But the risks are very different, but I just think valuation is still the biggest risk. These companies still don't look cheap on traditional value metrics, but you're relying on these businesses to absolutely dominate in the future and be able to create those big bottom line profits.
Now, you're very much a value investor. You've spoken many times about where you see opportunities. Europe and the UK as well. I know UK through the banks. Europe's been having an interesting time. We're just speaking to Martin Lakos. The DAX up some 30% this financial year. But again, looking at financials in Europe?
Yeah, look, I think the best time to have bought them was the panic 12 months ago when everyone thought Deutsche was going to roll over. So yeah. I'm not going to pretend we picked the bottom. It was tremendous. But I think it was only probably, 4 or 5 years ago, all we talked about was the peaks.
Yeah.
Portugal, Ireland, Spain, and just how terrible they were. Bond yields were sky high. And if you look at those countries today, they've actually taken their medicine and they're starting to recover. But they're recovering the right way. The budget deficits are coming down. House prices are going up. Interest rates are still very low. And tourism is picking up, even in Greece, of all places. So we don't have any investments in Greece, but there are some wonderful banks in Europe that are still trading at book value or less and pay 3 or 4% dividend yields, which is pretty good for Australian investors.
Absolutely. Nathan Bell, wonderful as always. Thank you very much.
Thanks, James.